Good afternoon. Welcome to the second joint initiative between ACE, Bills and Co, and WK Corporate Finance. Um, just before we kickstart, my name is Nelson Ogunshakin. I'm the Chief Executive of the Association for Consultancy and Engineering. The topic we have to cover today is about selling your business. Just before I go into the overall presentation, a quick reminder that the previous webinar is actually available on Bills and Co website, which is available on the event page. And if you wish to have a look at that as a starting point, please do so. A second reminder that people who actually wish to put questions forward are welcome to do so as we go through the presentation. This will be captured by one of my colleagues and the question will be put across to us. And the third one really is to do with CPD. For those who need CPD, this is a CPD accreditor. You can make an application to Bills and Co. and we'll be able to offer that. The subject we have to cover this afternoon is really to do with selling your business. I'm just about to give you a very quick overview. For me, I am the president and CEO of the Association for Consultancy and Engineering. We represent over 500 companies, employing over 120,000 professional engineers and consultants across UK, doing roughly about 9 billions. We have seen quite a lot of changes in the marketplace over the last few years, and this was the rationale for engaging on this sort of corporate agenda. Moving forward, as you know, we've got three particular parts to this particular program. The first part, we talked about growth strategy, which was presented on the 18th of November. This particular one is focusing on selling the business, and hopefully the third part we deal with post-merger integration, which we intend to cover on the 27th of January 2016. You may ask the question, what do you intend to get out of this particular presentation? There are three main focus. One is a strategic overview of how the corporate market is moving. And second is looking at it from financial point. And third one is looking at the legal aspect of it. And to address that, there are three speakers who is going to join me today. One is Dan Nixon, who is a partner at WK Corporate Finance. He was at the very first particular webinar. And also James Hutchinson, who is a partner at Bills and Co. Very experienced individual. And finally, my colleague from ACE, Dwight Patton, who is the Group Legal and Compliance Director, who will be taking questions and do the best to try and make sure we are on time. Moving on swiftly, there's always a question of why do you want to sell your business? Of course, every business goes through different phases of development, and really what I've tried to do is to bring out four main particular headings as to why people wish to or may want to sell their business, and I'll just basically go through them as quickly as I can, because the intention really is to give a sort of helicopter view and we can come back to details later on. First one is really responding to the market competition. We have seen quite a lot of competition going on in the marketplace. There's been a lot of consolidation. In the last 10 years, we've seen quite a lot of companies moved on from either being LLP, from LLP to limited company, and subsequently being PLC. But within the whole of the gambit of that, there's been a lot of changes in the way the market landscape has moved. So consolidation is here, and that becomes one of the big drivers in the market. The second point that I see really is about capital injection into the business. If you wish to expand the business and there isn't enough liquidity through reserve or through retained profit, then you may wish to sell either part of it or the entire business just to expand the business in terms of growth. Third one, which is quite obvious, is one about succession planning. The owner wish to move out as part of a retirement program and effectively looking for a new buyer to take over the business and take it to the next level. Fourth one, which I see and is quite common, is a situation where you're looking at an exit strategy. Effectively, either the current owner or the individual investor are looking for an exit over a period of initial investment, and from that point of view is looking for what is the best way of packaging the business moving forward. In all the 4 points that I've raised there, there can be a combination of that, or it can just be one single idea. Moving through, what are the options available for selling the company? As I've indicated earlier on, I won't go too much into depth because I believe Dan will cover that a little bit later on. And likewise, I'll have James going through the legal part of it. But just looking at the core option in terms of strategy, one, it could be an issue about dilution of ownership of the business, i.e., you wish to have additional partner into the business to expand the business, in which case you can actually put part of the equity of the business into the market for sale. Second one is really about succession planning. We've seen quite a lot of traditional movement in the consultancy and engineering sector where previous owners, either through age, retirement, are looking to bring young people into the company. And one of the means of doing that is through employee ownership scheme, in which case you, over the year, encourage young people to come into the company and you expand your share base of the company, in which case, you give equity away for a return in putting some capital into the business. The other area that seems to come up again and again is when you're looking at different countries and different parts of the world, either by region or country or sector, or you have a particular business, strategic business unit which you need to expand, in which case you need capital into that and you want to de-risk that by not going 100% alone, in which case you enable other third parties to come into the business. From that point of view, the issue is about how do you actually sell part of that business in a country which is perhaps not your home base or even the home base country. Sector, there are occasions where issues are up to do with businesses which are focusing on particular sector, whether it's rail sector or transport sector, and you wish not to go particularly 100% into that. There is an opportunity to dilute the shares of the business or to expand the business in that way. The final one, which I really want to touch on before I pass it on to Dan, really is looking at an outright sales of the business. And in that particular case, he's looking at your business and say, where's the strategic fit? How do you make the business fit into another organization? And effectively looking at that, targeting the type of companies and the type of organization and the type of culture that will fit into your business as you move into the next phase. So those 4 particular strategic options are always open to any existing owner who wish to put their business into the market. And just to try and round up on that, one is by dilution of ownership. Second is succession planning. And thirdly is about joint venture into entry into new market, a new sector, a new country, or a particular region of business. And the fourth one is really looking at outright sales of the business. And in that case, you're looking for a strategic fit. On that note, without spending too much time, I'm just going to hand it over to effectively Dwight, who is going to moderate for any questions that may have come through. Dwight.
Thank you, Nelson. Yeah, we have got a bit of interest in your part here. The first question I'd like to ask you is really what trends are you seeing in terms of the reasons for selling a consultancy and engineering firm?
The general trend over the last 10 years is one about dealing with the growth of expanding the business, and it's always about being part of a big organization. So we've seen quite a lot of people who are retiring from their business, and constantly they find it very difficult to find young ones who are committed to stay in the business and buy shares in the business. And in terms of dealing with that ownership structure and transition, effectively the only way you can get real value out of those existing owners is really to unbundle the business. In most cases, either you do 100% outright sale or sometimes you do partial, in which case, some existing shareholder in the business wish to dilute or unbundle their shares and you can bring the new owners into it. But predominantly it's been to do with growth and it's to do with succession planning.
And are you seeing particular parts of the consultancy market under more pressure to sell than others at the moment?
I think if you look through the class of players in the market. There are big players who are over 1,000, and there are companies which are really between what I call 250 and 1,000. We've seen more of that sort of companies in the market for sale recently because of the pressure that operating, being in that middle band where you're not large enough to make the critical mass, and you are small, or sorry, not small enough to be able to be agile, and the sort of investment that you require in the business to keep it going requires the entity to be part of a bigger player, and that's been in one area of seeing sales in more last 10, 15 years.
Oh, thanks. I mean, the other thing is around whether you want to sell the whole of your business or just part of it. I wondered if you could say a bit more about the decision-making process in terms of whether you go for whole or part sale.
Dan will probably address this more into detail at a later stage, but from where I start looking at it from a helicopter view, the most important things when you're looking for sales is make sure you have a buy-in within your management team. The second point is deciding what level of capital do you require for your expansion of business. In that particular case, you would then decide how much of the share base you want to dilute and what else you need to bring into the business. But the traditional approach has always been look at the growth of your particular market, decide which area of growth you want to move into, what level of capital you require in there, and then effectively decide, what part of it that you really want to keep or what part you want to sell. The most important things in selling part of the business is really about injecting capital into the business.
Thanks, Nelson. I mean, there's one other thing, and Dan will cover this in probably more detail, but when you've actually made the decision to sell and how you want to go about it, how would you go about approaching a potential buyer without actually compromising your position in terms of your business?
Okay, I'll basically give you very quick heads on that, and I suspect that this is one thing that I believe James will address more in detail later on. I think the key thing is, like any other business you want to address, if you wish to put yourself in the market, the most important thing is be in the industry circle, understand what type of business will be a good fit for your business. But more important, you really need to be among players that you think will be a good fit for you. And industry gatherings always a starting point. Conferences, listen to people and people who are bidding in the same space as you, and you can see where the synergy may be, both in terms of culture orientation, both in terms of how their business and your business will fit with theirs, and also exploring with people initially, perhaps through joint venture on project by project basis before you decide to go 100% into sales of the business. But the most important thing is to identify companies that you think will have the right culture fit and will allow you to achieve your objective through the sales of the business. And that means really getting to know people and really talking to people to check whether their own business agenda align with your business and agenda before you even actually contemplate putting your product in your business in the marketplace.
Sounds like that's a process that could actually take quite some time before you really want to make the leap.
Well, nothing is quick in life. I mean, it's a big decision for any company director to put their business in the market, and so people have sense of ownership. So it's very important that whoever you want to sell the business to, they have to be the right fit and they have to be the right person that carried people along, because it's a people's business. And it's not just about selling and getting the money out, it's about how do you transcend on. So the critical point is really get involved with the industry, know your competitors, identify who you see there with some potential good fit, engage with them either through joint venture on project by project basis, or at least appointing professionals who can help you to do that.
Thanks very much, Nelson. We're going to hand over now to Dan Nixon, who's going to look at the financial side of selling your business. Dan, over to you.
Thank you very much, Dwight. Good afternoon, everyone, and welcome to this short presentation on finding a buyer and selling your business by me, Dan Nixon. A bit of background on me and my firm. I'm a partner at top 20 accountancy firm Wilkins Kennedy and director of corporate finance. I'm a qualified ACA accountant. I've been working in corporate finance for more than 9 years and have advised on 80 plus completed transactions. WK Corporate Finance is a wholly owned subsidiary of Wilkins Kennedy, which has multiple locations in the South East and London. We offer a complete range of corporate finance services in the SME space, to private clients, as well as to institutional funders. We specialise in lead advisory and transaction support services, advising clients on all aspects of the deal from start to completion. Typical transaction values are in the £2 to £50 million range. I'm now going to talk about how to find a buyer and selling your business. So first up, I'm going to cover preparing to sell the business. I'm then going to consider how to maximise the value of your business. And then finally, I'm going to look at potential alternatives to an outright trade sale. Selling a business is likely to be the largest and most important financial deal any business owner will ever make. Selling the business you have spent years building up can prove to be emotionally difficult. Prior to any sale, it is worth taking the time to consider what your objectives from a sale would be, remembering Nelson's previous slides and covering his 4 reasons. This would typically mean planning well in advance of a sale transaction. This could be 12 to 18 months, but could also be as much as, say, 3 years. The value of a business and your ultimate sale price will be directly affected by good and early preparation. Assemble a team of trusted advisors and specialists to help you with your accounting, tax, legal, and M&A matters. Take early tax advice to highlight issues which might affect your deal later. Confidentiality is key. Keep it secret until you have found a buyer and done a deal, because uncertainty seriously damages businesses. Employees can lose motivation or exit the company, and thus potentially affecting business performance. Reevaluate the cost base of the business. Take tactical steps by cutting out on unnecessary costs. Early on, focus on operational efficiencies so that it is easily demonstrated to a potential buyer. Ensure you have strong financial controls and processes in place. Presenting your business with solid cash flows and a strong management will position the business as an attractive acquisition target. Revisit your organisational objectives. It is essential that you are convinced by your own vision and strategy. If you are not, neither will your buyer. Find the right buyer. Ensure you tick their boxes. See the business through the eyes of a potential buyer. Play devil's advocate. Consider who would or could be interested in acquiring the business. Consider why they would be interested in buying your business. Consider what makes you specifically attractive to them. Understand subjective value. Prepare a list of these companies. If possible, categorize them. For example, Category A could be those interested in acquiring the business for its technical know-how, expertise and customer base. Unlike Category B, who could be more interested in acquiring the business for its infrastructure, systems and asset base. Prepare to feed any potential buyer the right information to ensure they would be interested in the business as an acquisition opportunity. Having considered some of these areas around preparing to sell the business, I will now come on to consider how to maximise the value of your business. So having prepared the business for sale, you can now focus on some key areas. First, make sure the business isn't dependent on you. Ensure that day-to-day issues are not down to you to resolve. The more time you spend on day-to-day activities in the business, the less value it represents to a potential buyer. Pass on your technical expertise to the business. Consider how a new owner without as much experience or technical know-how as you will run your business. Recruit or promote a suitable successor. Put a management structure in place, or consider providing ongoing consultancy. Diversify client revenues where the market permits. Reduce dependency on your top 5 clients. A very good benchmark would be no one client representing more than, say, 10% of your revenue. Recurring revenues and multiple revenue streams. The larger the portion of a company's revenue that is recurring, stable, and likely to continue in the future, the more desirable that company is. In addition, multiple revenue streams can help reduce the risk around any single product or service failing or suffering a downturn. In other words, buyers are more willing to pay a premium for businesses that demonstrate predictable earnings for the future. Proportion of revenue generated by contracts. Maintenance contracts, service contracts, or retainers represent significant inherent value for the buyer, as they guarantee regular income with little further sales effort. Also, try to maximise the duration of your maintenance contracts. Ensure historic financial reports are in order. It's important to present your accounts as attractive as possible, but it is more important that buyers believe in your accounts. Get all the skeletons out of the closet. Make realistic provisions for bad debts. Buyers and their advisors will usually see through any quick fixes you try to boost profits. Tidy up your business. Ensure equipment is all well maintained, company records are organised, key contracts, including property leases, suppliers, customers and employee contracts, which I'm sure James will cover in more detail in the next part. Ensure they're in order. Ensure there's no outstanding litigation or unresolved disputes. Show strong financial performance. A major area to consider here is working capital. You can show strong control on working capital by reducing stock levels and controlling creditors. Also reducing debtors, of course. Maximise short-term profits by reducing long-term loans. Buyers not only want to see profits increasing year on year, but also a full sales order book. Develop sound financial forecasts. This should be as realistic as possible and preferably supported with evidence. And timing. When you choose to sell can have an impact on price. Selling when you don't have to improves your position of negotiation. So having considered maximising the sale price, I'm going to consider some alternative exit routes. A common way of selling your business outright is through a trade sale to another business, often already involved in the same industry. It is generally the case that a trade buyer will pay more for the business, thereby maximising shareholder return. Other potential alternatives to an outright trade sale include private equity. A private equity investor is typically looking to generate a substantial financial return over a 3 to 5 year period. It could be via a majority stake or a minority stake in the business. Either way, there will always be a stake for management. The reason being they want equity in the hands of those responsible for driving and delivering growth of the business and ultimately value. Typically their investment is structured in a variety of financial instruments on a new company's balance sheet. Short-term debt, long-term debt and equity. Venture capital. This is money provided to early stage emerging and fast growth companies. Venture capital funds tend to invest in companies in exchange for equity. Venture capital is a type of private equity. MBI, or management buy-in, is where a manager or management team from outside the company buys the company and manages it. The challenge with this is finding the right management team with the right skill. MBO, or management buyout, involves the management team pooling resources to acquire all or part of the business they manage. The management team takes full control and ownership, using their expertise to grow the business. It is usually funded by a mix of their own money, external financiers, and the seller. A management buyout is appealing to professional managers because of the great opportunity for potential rewards from being owners of the business rather than employees, and can be a lower risk investment opportunity for them. With leveraged buyouts since 2008 we've seen less of these. However, the concept is one which can map across all of the above. The concept is that to fund the transaction, a significant amount of money is borrowed to meet the cost of the acquisition. The assets of the company being acquired are used as collateral. So to recap and bringing together the three parts of this presentation of preparing for sale, maximising price and alternatives to a trade sale, Evaluate your objectives, your exit strategy timetable, and engage your advisor. What do you want to achieve? If you're the owner-manager, is it a retirement sale, for example? When would you ideally want to transact? Remember, timing can impact value. Evaluate the business, its market, and determine potential buyers. What is it that's attractive about the business? Does it operate in a niche market? Who could buy the business? Determine your subjective value. Your business will not be worth the same to each potential buyer. There may be a strategic price, a premium that a trade buyer is willing to pay. Focus on the key value drivers in the short term. Once your exit strategy timetable is in place and you've evaluated what drives the value in the business, whether it's type of revenues or operational efficiencies, a plan can be assembled to drive value. Get your house in order. Having clear, concise, and detailed financial information available on a monthly basis, having KPIs that attract, managing the working capital cycle of your business effectively to drive positive cash flow. Consider who to approach. Trade may pay more, but maybe that doesn't meet your objectives. Shape the information through a confidential flyer and more detailed information memorandum. Drive a competitive process. Competition can drive price. To hold on to that price, ensure the due diligence process and timetable is being driven by your advisor. Stick to the timetable. Negotiate. Understand your position of negotiation on certain points. Consider points that you might be willing to concede and points that are deal breakers. Understand aspirational, acceptable and unacceptable levels. Finally, complete. It's very easy for transactions to slip. In my experience, a transaction that slips often increases the risk to the seller. Risk that confidentiality may be broken. Risk that trading may slip. Driving the timetable to completion is key. This now brings me to the end of my presentation. Thank you for listening, and if you have any questions arising, please either contact us via the webinar or follow up using the contact details on the screen.
Thank you, Dan. Actually, we've got some interest from the audience, particularly around the question of which way to sell the business. And I wondered, one thing in particular was your comment about trade buyers typically paying a bit more, and I wonder if you could say a bit more about that or why they might pay more.
Yeah, sure. So I think I mentioned on a couple of occasions during that during the webinar that trade buyers do typically pay more, and it is to be fair, it's a question that we often get asked, and it's down to this point around subjective value. In the previous M&A webinar in November, I talked about the theoretical methods of valuation, and that sometimes theoretical value doesn't arrive at exactly what someone is willing to pay. For example, if the interested party is a competing business and you are gaining market share from them, they could see you as a longer term threat to their business and would be willing to part with more than a theoretical value to protect their business and rejuvenate its business life cycle. There are many other reasons why a trade might pay more, but you can fundamentally house it within this idea of subjective value.
Oh, okay, thanks. That makes sense. The other question we had was around this leveraged buyout concept, and I wonder if you could expand on that in a bit more detail, how that might look in a private equity transaction.
Okay, sure. So a leveraged buyout being where the business being sold becomes collateral for the funding structure to affect the transaction. Probably the easiest way to answer this question is to use a hypothetical example. So let's take a business that's doing 2 million EBITDA, being sold for 10. Let's assume the cash on the balance sheet of the business being sold is remaining in the business and equals any fees relating to buy side, so arrangement fees, DD costs, etc. i.e. this leaves a funding requirement of £10 million. A leveraged buyout would be something like £9 million of debt and £1 million of equity. And then taking that 9 million of debt, this might be say 4 million of senior debt, 2 times EBITDA, which is repayable perhaps quarterly in arrears over 4 to 5 years, and then the balance being longer term loan notes, which are repayable in one lump sum in 5 years time. And the main reason private equity transactions often take this form or type of structure is that a pure equity return doesn't achieve a satisfactory level of return to them. They therefore use financial structuring and engineering to achieve their desired and acceptable level of return to risk.
Thanks. And just that the example you were giving there in terms of the amount of senior debt and the other parts of the transaction, are those numbers typical of what you're seeing in the market at the moment?
Yeah, so in terms of the example that I picked was a 2 million EBITDA business and a 10 million valuation, so an implied 5 times multiple. That's not unfair. Corporate finance advisors always tend to be a little bit sketchy when it comes to the specifics of a company valuation. So we often give a range, and it goes back to this point about the true value being what someone is willing to pay for a business. But that said, multiples of sort of 4 to 6, I would say, is probably where we've seen the market in recent years. We're starting to see that grow, and that's really being driven by the just general economic pickup.
Great. Okay, thanks for that, Dan. Just very quickly, before we hand over to James, a question on preparing for the transaction. How much? It's a bit broad, so kind of try to keep it brief, please. But how much information should your seller have available, and when?
Okay, that's a good question. I think it's all in the preparation. So get the house in order, reevaluate your business, get the financial information prepared. From a financial perspective, monthly P&Ls, balance sheets, cash flow statements, detail behind your revenues and your gross margins. And just remembering, in a transaction, there'll typically be 2 occasions when a substantial amount of information will be required. The first will be when you're preparing the information memorandum, which is the principal sales document that's prepared and provided to interested parties. And second is during the financial due diligence phase.
Presumably, you've got to be quite careful in choosing your core internal sales team in terms of, obviously protecting confidentiality and keeping your key staff, on board during the process.
Yeah, absolutely. I touched upon the sort of the top secret nature of transactions, and I think but on the other side of that is how do you satisfy such a substantial information request in a short period of time, remembering that particularly at the due diligence stage, there'll be requests coming in from all directions: legal, commercial, operational, property, not just financial. So you should perhaps consider bringing other people into the fold, as you rightly say, Dwight, and key management perhaps. So measures such as bonusing them on the successful outcome, for example, of the transaction, can align interests where there isn't any equity. It's this sort of circle of trust.
Brilliant. Okay, we're going to hand over now to James Hutchinson of Beale & Co., who's going to look at the legal aspects of a sale of a business. James, over to you.
Thanks very much, Dwight. Hello, everyone. I'm James Hutchinson, a partner in the corporate team of Beale & Company. Dan has discussed how you prepare your business for sale, how to maximise value and potential alternatives to an outright sale. I'm going to look today at the legal process once you've made the decision to sell and how to minimise your risk. So my talk is going to cover 4 main areas: the legal structure of a sale of a business, so why you might go for a share sale versus an asset sale, and the factors influencing that kind of deal structure; the due diligence process, so what is the purpose of it, what's the scope, a bit of information about due diligence questionnaires, and how to answer and collate the queries that come in. We're going to have a brief look at the legal documentation, your heads, your share and asset purchase agreement, but our focus on the disclosure letter. And then finally, how to protect the seller's position, by limiting your liability and the use of the disclosure process. So if you have decided to sell a company, there are usually two main ways to structure it. The first being by way of a share sale, which involves you selling the shares of the company. And the second is a business or asset sale. So in this alternative approach, the company simply sells each of the individual assets that make up the target business. So at the end, you as the seller still own the company, but its assets now include the sale proceeds. I've talked about companies, but if you're selling a partnership or a limited liability partnership, then without going into more complicated restructuring arrangements, it would usually be conducted by an asset sale. There is a fundamental difference between the two deal structures. When you sell shares in a company, all its assets, liabilities and obligations are acquired. But if you go down the asset route, only the identified assets and liabilities that the buyer agrees to purchase are acquired. There are a number of key factors which might influence which structure you go down. The first one of those is liabilities. Sellers often prefer to transfer the whole company or group of companies lock, stock and barrel, and that's done by way of a share purchase, and that's because the sellers don't want ongoing liability, and they're prepared to give warranties and potentially indemnities to the buyer. By contrast, many buyers prefer the asset purchase route because they'd like to cherry pick excuse me, some of the assets that they want to buy. Various reasons for this, we can look at tax can be a particular influencing factor in what structure to play, but also it might come down to that you're looking just at a partial sale. Where there is a partial sale, for example, you're selling off a division of the business which is no longer core, it might be more practical to structure the transaction as an asset purchase. Otherwise, it'd be necessary to first set up a new company and transfer what's called hive off the relevant part of the business into the new company so that company's shares can be acquired. Finally, one of the other factors influencing structure is consents. Where third-party consents are required to transfer assets, and it's impractical or thought to be impossible to obtain any of those necessary consents. For example, client consent to the assignment or novation of a contract, a share purchase might be the only practical way of selling the target business. So, due diligence. This is the information gathering process carried out by the buyer to find out as much as possible about the target company. This usually starts at the outset of negotiations and runs right till completion. However, throughout the process, the aim is to gain a complete picture of the target, critical success factors, strengths and weaknesses. The information obtained through due diligence will help the buyer decide whether they want to proceed with the acquisition, and if so, at what price and on what terms. It's therefore vital that sellers do not put the deal at risk by failing to properly manage the process. Because of the greater risk assumed by a buyer of shares, the level of DD required on a share purchase will usually be more than an asset purchase, and the focus of the legal DD will depend on the nature of the company that's being acquired. So if the business is, for example, a consulting engineer, the buyer will usually spend a significant amount of time reviewing the seller's appointments and contracts. The DD exercise generally consists of an assessment of financial, legal and commercial status of the target, and it's typically carried out by the buyer's financial and legal advisors in conjunction with its own employees. As a seller, one of the first documents you're likely to receive from the buyer or their solicitors is a due diligence questionnaire. It can come in it can be named really lots of different things. It might be called a request for information, a legal review questionnaire, or a legal due diligence information request. They're all pretty much the same thing, and what they are is a list of inquiries that the buyer is making about the business. Within this document, it's usually got a number of headings, and they might be things like corporate structure, the accounts, contracts and trading, insurance, employees, pensions, tax, etc. And what they're trying to do is find out as much as possible about the company by asking a number of questions. It's important to properly manage the due diligence process, as Dan mentioned and as Dwight raised in a previous question. As we'll discuss a bit later on, if the DD process is not dealt with properly, it can really slow the disclosure exercise as well, and we'll come on to that. However, responding to DD questions is extremely time consuming, and sufficient resources need to be available to search, to scan, to email and to review documents. Often a buyer will ask for things like bespoke spreadsheets of data to be created, and the seller's management team will need to be able to continue running the business as well as answering those queries. Whilst you might need a fairly largest team to get all the information together, it's usually a good idea to assign one or a very small team of people to actually collate the answers that are sent to the buyer. These people should keep control of how information is provided, whether it be in full responses to the DD questionnaire, documents requested in meetings, or just answering email queries. One of the easier ways to collate all this information is by setting up an online data room. This allows the sellers to keep control of all information provided to the buyer and its advisors. A lot of the functionality you now get with online data rooms can be set up to prevent the buyer from downloading, printing or editing the data. This can be important when sellers have maybe some slight doubts about the buyer's intentions, or may be reluctant to disclose sensitive information to a competitor in case the information or the acquisition falls through. Another benefit is that most data rooms now automatically index and number the uploaded documents, which can be helpful when we're preparing the disclosures against the warranties. So there's a number of key legal documents which will be prepared as part of the sale of the business. The first is the heads of agreement. The purpose of this document is to outline the main terms of the proposed deal, provide a structured basis for negotiating the rest of the formal documents. The share or asset purchase agreement. In the case of an asset purchase, the asset purchase agreement is the main contractual document affecting the transfer of the assets from the sellers to the buyer. And in a share purchase, it's the principal contractual document for transferring the shares. As well as containing lengthy warranties and potentially indemnities, the agreements deal with how the consideration is to be satisfied, whether there's condition precedents, and other completion arrangements. On a share purchase, the SPA will also usually include a tax deed where the sellers agree to indemnify the buyer against various tax liabilities. After the SPA or asset purchase agreement, the next most important document for the sellers is the disclosure letter. A warranty is effectively a statement of fact, for example, that the company is not involved in any litigation. If that fact turns out to be untrue, then the buyer potentially has a claim for a breach of that warranty. However, no claim will lie if the facts which give rise to the breach were set out in the disclosure letter. It therefore gives the sellers the opportunity to correct or clarify the warranties and therefore limit their liability. Sellers often wonder why they have to go through due diligence only to repeat some of it at the disclosure stage. It's important to understand the difference between these two processes. Due diligence is there to provide the buyer with information about the business, and disclosure is there to enable the sellers to correct the warranties and reduce their risk. If the sellers have properly managed the DD process, collated all their answers, then it should greatly simplify the disclosure process. I would usually tell the buyer at an early stage in the transaction that the sellers intend to disclose in the disclosure letter all of their responses to the buyer's due diligence questionnaire. Whether this is acceptable to the buyer will always be a matter of negotiation, and will also depend on how well that due diligence process was managed at the beginning. The disclosure letter itself is divided into two parts: general disclosures and specific disclosures. General disclosures include generic matters, such as disclosures of matters which can be found at company's house and usually a number of years' accounts. These will usually be prepared by your solicitors to reflect the type of business being sold and the information which the buyer has had access to. Specific disclosures disclose actual matters which, if not disclosed, would constitute a breach of the warranty. The specific disclosures are produced by reference to the warranties themselves. For example, about the no litigation warranty I just mentioned, the sellers would need to disclose details of any current litigation affecting the business. It's in the seller's interests to make the disclosure as full and as complete as possible to reduce the risk of a claim for breach of warranty. Therefore, they should not only mention the current litigation in the example I gave, but provide a summary so that the buyer understands the background, and you should direct the buyer to relevant sections of any attached disclosure documentation. Again, where there's an online or virtual data room, it can be particularly easy because you can refer back to the particular numbered document in that data room. So there are various ways to protect the seller's position. Looking first at protecting the consideration, it's rare, unfortunately, that a seller will pay 100%. A buyer will pay 100% consideration for a business on completion. Usually, at least part of the consideration will be deferred, whether that's through an earn-out or just on a stage payment basis. The sellers therefore need to conduct their own due diligence into the buyer to ensure that they're satisfied that if they become entitled to the deferred payments, that the buyer can and will make the payments. This can be achieved in a number of ways. For example, obtaining guarantees, requiring the money to be paid into an escrow account, or maybe obtaining some form of security. Which of these might be appropriate will depend on the nature of the deal and the risk of default by the buyer. The seller will also usually try to limit their liability for warranty claims. The potential liability is usually, in most agreements that I see, limited to the amount that can be claimed by the buyer. For example, I would say that sellers should not be liable for more than the consideration they've actually received. As to the period of time within which claims can be brought by the buyer, and as regards matters that have been disclosed to the buyer. Most of these are usually agreed by the buyer, but you can also push for additional limitations, such as requiring the buyer to seek recovery or reimbursement from a relevant third party, such as an insurer, before it can pursue a claim against the sellers, or excluding liability for claims that arise or increased as a result of the buyer's voluntary acts. We've already mentioned that the warranty disclosures are another way that the sellers can seek to limit their liability. And finally, with proper wording in the sale documentation, to which the extent to which the buyer's knowledge derived from sources outside the disclosure letter, for example, as part of the due diligence process, that also might be relevant to the seller's possible liability on any kind of warranty claim. My view is it's never equitable for a buyer to have actual knowledge of a fact. It might not be disclosed, but then them still to be entitled to bring a claim for a breach of warranty. So my view is that that should always be included. Thanks very much.
Thank you, James. We're probably 1 or 2 minutes behind, so just fire a couple of quick questions at you from the audience. And by the way, this is your last chance, audience, to let us have any questions you have for the panelists. First one is around, well, it's just the volume of potentially sensitive information that you're going to be handing over as part of the DD process. And you mentioned about data rooms and some of the mechanisms in there, but how do you, if you're a seller, how do you stop a buyer from using your confidential information for its own commercial purposes?
Yeah, it's always very very difficult to do, but I would say at least at the very outset of any transaction, you should be agreeing binding confidentiality provisions with the potential buyer. That would normally be in a separate confidentiality agreement, or there may well be specific terms set out in maybe the heads of terms themselves. You just need to make sure that those provisions in heads are binding. But we also need to think about what happens if the deal falls apart at a later stage. Is the buyer required to return the relevant information, or just confirm it's been destroyed. As I said, online data rooms can be very helpful in managing who has access to the data, preventing them downloading it, etc. But it never prevents an unscrupulous buyer from taking a photo of a screen or scribbling down some of the information, some of your client lists. There's not much you can really do about that. If there is no obligation to provide a buyer with any particular data. So if you have concerns, maybe hold some of it back till later on in a transaction, but be aware that that might risk changing the price if there's something negative in there, or redact certain sensitive information and just make it clear to the buyer that it might be released at a later stage.
Thank you, that's helpful. And then you mentioned about indemnities in addition to the warranties. Why is a buyer seeking a number of indemnities as well as warranties?
Well, hopefully they're not seeking too many. Usually on a share sale, they'll be entitled to a tax indemnity, and I would push back quite hard for any other kind of indemnities. But it arises out of the difference between a warranty and an indemnity. So under the warranties, if a buyer wants to bring a warranty claim, they have to prove that A, the warranty has been breached, and B, the effect of the breach is to reduce the value of the company or business acquired. And that second part of the test can be quite difficult to prove, that the actual value of the company has been reduced. But in contrast, an indemnity is a strict promise to reimburse the buyer in respect of a particular liability should it arise. So if you say the liability in respect of an ongoing claim won't be more than £100,000, if it's £101,000, anything over 100,000 will be repayable on a pound for pound basis. So it enables a buyer to recover on a pound for pound basis. So that's why in regard to specific liabilities that they're concerned about, that they may seek an indemnity, and they should be very limited, and any sellers should look at them very carefully, but should not be agreeing to many of the warranties being on an indemnity basis.
Thanks. I mean, clearly, negotiating the warranties is a big part of what you're doing on the legal side, James. I just wondered, in your experience, which types of warranties tend to be problematic in the negotiations, and how does any deadlock tend to get resolved?
Yeah, what we sometimes see is as well as having specific warranties that are a bit difficult or are problematic, is we sometimes see fairly generic long lists of commercial warranties and acquisition documents. So there might be 20-30 pages of just general commercial warranties, many of which have little relevance to the business. So we might be dealing with a consulting engineer who is a professional service business, and we see lots of product warranties which are completely unreasonable. As long as you're dealing with a reasonable buyer and reasonable advisors on the other side, those should be deleted or at least limited. Specifically, type of warranties that often come up in regard to sales of consulting engineers, for example, one of the ones that can be a problem is about a company's contracts. So the appointments that you've entered into. Buyers might be asking the sellers to warrant that all the contracts contain, say, for example, a limit of liability or are capable of completion within a very limited period of time. The buyer probably knows full well that many of those contracts don't contain a limit of liability, but what they're trying to do is push the obligation on to the sellers to dig up all that information for them. I would really be seeking to amend the warranty to provide them with a list of what the contracts are, provide them with those contracts, and it's for them to satisfy themselves that they are happy with those contractual terms, because that is what they'll be getting if they buy the business.
Thanks, and that's another good reason to limit liability in your negotiations of your appointments. I'm going to have to bring your section to an end, James, but thanks very much, and that just leaves us to hand back to Nelson, who is going to pull together the themes from today and conclude. Over to you, Nelson.
Thank you very much, Dwight. Just to try and wrap up, I think we started with a very quick overview as to why and what are the drivers for wanting to sell your company. And I think it's fair to say that I talked about four possible sort of options to consider. We had Dan that came in, looks at the financial side of it in terms of how do you package your business and how do you maximize the value, and look at the potential alternatives to the outright sales. Finally, you've got James coming in to look at the legal setting in terms of the due diligence and the process that is required. What really boils down to me is just really to give us some headlines of things to look out for. First of all, is really looking at the point issues. If you are going to sell your company and you're not the sole owner, or even though if you're the sole owner, you do have a management team, it's very important that you need to secure internal agreement within your team. I look at the strategic intent within the partners and make sure you focus on what you want to achieve. That's critical. Second point, which I think is quite pragmatic, is really having what is your strategic objective? What do you want to get out of the transaction? I think in all the conversation that I've had from Dan and James is really looking about, having a clear idea of what you want to get out of it. So focus on the expectation and whether it is about maximizing what you get out of it or actually transcending the business from one generation to the other. That's pretty important. The issue about identifying buyers is critical, but you've got to be very specific. Are you looking at strategic business unit as what you want to sell out? Or is it a regional business that you wish to divest? Or is it the entire business? You need to be absolutely clear at the beginning what your objectives are. It's fair that James talked a lot on due diligence, and actually that's on both sides, both on the financial due diligence, on the legal due diligence. Both needs to be looked at. This is critical, but again, it's important for any buyers that's going to look at your business to make sure that they actually check all the process. It takes time. It has to be done, but more importantly, it has to be done properly. Valuation of the enterprise, never overengage. Don't expect too much. I think, seek the best advice from your financial advisor. They will always give you a band. It's never, a particular, smart issue. It's about what people see in your business and how you package your business. So the valuation process is actually quite important. One point actually was that what we didn't talk about in our process about deal negotiation, which is very critical. When you are in that process of engaging a buyer, negotiating the deal, you do need professional advice in that process. Make sure you go in with a clear objective and know exactly what you want to achieve out of that. Transaction management, again, I think James talked about the process of the due diligence and also talked about the need of using technology to make sure your data is not actually, but the transaction has to be properly managed. It may sound very expensive, but it's critical. And finally, last 2 points I really want to touch on is the issue about stakeholders engagement. Whilst confidentiality is critical internally, and externally, but it's very important you carry people along the line, because at the end of the day, when the buyers start looking through the due diligence, start talking to the staff, start talking to the management, if they don't see an aligned vision and objective, then people may walk away from that deal. So it's very, very important. And the final point, which is going to lead us to the point we're going to cover in January, is one about post-merger. In another word, if you are selling, how do you expect the new world to be in? If you are going to be in the business, what role do you want to be in that business? And how do you manage that particular transition? And how do you manage the integration of the old business into the new business? Otherwise, you may end up with the business not knowing exactly how much to go for. On that note, I think we've covered as much as we can in the first webinar, which is looking at, how do you grow your business? This particular one is looking at how do you sell your business? And the final we'll be looking at in January is how do you ensure post-merger? And that has an element of finance, has an element of legal, and also has an element of strategic. Thank you very much for joining us. I hope you've enjoyed it.